When Jamie Dimon speaks, markets move. And this week, his words sent a chill down Wall Street's spine. The CEO of J.P. Morgan Chase, the most powerful bank in America, just warned that U.S. stocks may be heading for a major correction. He said investors have become too comfortable, too greedy, and too convinced that the AI-driven boom will never end. Dimon's warning wasn't about panic. It was about perspective. And right now, that perspective is exactly what the U.S. market needs. Because beneath the record-breaking highs, there are cracks beginning to show. Let's unpack exactly what Dimon said, why it matters, and how it could reshape business decisions across the country. To start, the U.S. stock market has been on fire. The S&P 500 has climbed more than 20% this year. The Nasdaq has surged even higher, driven by the so-called Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla. Together, these 7 companies account for almost half of the market's total gains. It's a level of concentration that feels eerily familiar to those who lived through the dot-com bubble of the late 1990s. Back then, tech optimism blinded investors to risk until reality hit. Dimon says we could be watching history rhyme once again. In his words, the market is showing complacency at the top. In other words, too many investors are acting like nothing can go wrong. But Dimon sees 3 flashing warning lights. The first, the AI bubble risk. Artificial intelligence has become the new gold rush. Every CEO is talking about it. Every investor wants exposure. From chip makers to cloud platforms, the word AI alone can send a company's stock soaring. But Dimon's point is this: while AI is transformative, the hype cycle always runs ahead of reality. The technology will reshape the economy, no doubt, but revolutions unfold slowly. The internet didn't change everything overnight. It took more than a decade of trial, error, and infrastructure building. AI will follow a similar path. Right now, valuations are pricing in perfection. Limitless growth, no regulation, no competition. That's not sustainable. The second warning: interest rate pressure. The Federal Reserve's war on inflation has kept rates at their highest level in decades. And while that's good news for savers, it's squeezing borrowers. Businesses refinancing debt are paying far more than they did a few years ago. Startups dependent on cheap capital are struggling to raise funds. Consumers are feeling it too. Credit card rates are near 25%. Auto loans are stretching household budgets. And the housing market is frozen. Dimon believes that if rates stay high for too long, growth could grind down, corporate earnings could slip, and the illusion of endless expansion could fade. When profits slow, markets fall. The third warning: geopolitical tension. Wars, trade disputes, and shifting alliances are making the global economy unpredictable. From the conflict in Eastern Europe to tensions in the South China Sea, the world is walking a fine line. Add to that the U.S. election cycle, new tariffs, and uncertain fiscal policy, and you have the recipe for sudden volatility. Dimon's concern is that investors are ignoring these risks, assuming they'll always blow over. But markets don't correct slowly. They correct suddenly. So what happens if he's right? Let's imagine a few scenarios. If the AI bubble deflates, capital could shift from speculative tech to stable industries like energy, manufacturing, and healthcare. If rates remain high, small and mid-sized businesses might face a credit crunch, leading to layoffs and lower consumer spending. And if geopolitical tensions flare, global supply chains could once again be thrown into chaos. That's not doomsday. That's just how cycles work. Dimon isn't betting against America. In fact, he's known for being one of the most optimistic voices about the long-term strength of the U.S. economy. He believes American innovation, productivity, and entrepreneurship will carry us forward. But he's warning that the road between here and there could get rough. And it's not just about the stock market. It's about behavior. When markets go up for too long, risk management goes down. Companies start overspending. Investors stop asking questions. People chase momentum instead of value. That's the danger he's pointing to. The mindset that says, "This time is different," but it never is. Every boom in history, from housing in 2007 to crypto in 2021, ended when optimism turned into arrogance. And every time, those who stayed grounded survived. So what should business leaders take from Dimon's message? Number 1, focus on fundamentals. Cash flow, profitability, efficiency. Those are what carry you through the storm. Number 2, be cautious with debt. Cheap money is gone. Borrow only when it creates long-term value. Number 3, think beyond the hype. AI is powerful, but it's not magic. The winners will be the companies that use it to solve real problems, not just boost investor excitement. Think back to the dot-com bust. Thousands of internet startups vanished, but a few, Amazon, Google, eBay, survived and reshaped the economy. They did it because they built real systems, real products, and real customers. We're entering that kind of moment again. The AI revolution will absolutely change business, but it will also separate the dreamers from the doers. For investors, Dimon's words are a reality check. Diversification still matters. When everyone crowds into one sector, like tech today, even small shocks can ripple across portfolios. For small businesses, it's a call to stay flexible. Economic uncertainty often creates opportunities. During downturns, weaker competitors disappear, costs fall, and smart operators expand. And for policymakers, it's a reminder that stability matters as much as growth. When government gridlock or trade wars shake confidence, it's Main Street, not Wall Street, that pays the price. Dimon's message cuts through the noise. America's economy is strong, but not invincible. The AI boom might be rewriting the future, but it doesn't make us immune to cycles. Markets rise on excitement and fall on reality. Right now, reality is knocking. Inflation remains sticky. Borrowing is expensive. Global politics are messy. And the world's biggest banks are quietly preparing for turbulence. Maybe Dimon is wrong, and the market keeps soaring. Maybe AI really will deliver decade-long productivity gains that justify today's prices. But if he's right, even partly, the next correction could be sharper than most people expect. So as the headlines celebrate trillion-dollar valuations and record highs, remember this: the same optimism that fuels bull markets can also blind them. Dimon isn't telling investors to run, he's telling them to wake up, because in every boom, there's a moment when people stop asking whether prices make sense. That's the moment when discipline disappears, and risk takes over. We might be closer to that point than we think. And when the market finally breathes out, the businesses that survive will be the ones that built patiently while everyone else was chasing hype. That's what Jamie Dimon is really saying. Not fear, but focus. Not doom, but discipline. Because in the end, markets recover, but only the prepared last.